Is it gold's time to shine? Hi, everyone. Welcome to the Real Vision Daily Briefing. With me today is Tavi Costa, member and macro strategist at Crescat Capital. Hi, Tavi. It's great to see you.
Hi, Maggie. How are you?
I'm doing well. We were just discussing before we came on air. Tavi is a new father. So, massive congratulations to you. Welcome to the tribe and to the
Hey, thank you.
madness. We've got a lot of veterans out there. So, feel free to weigh in with any parenting advice you might want to give Tavi, and we'll be sure to pass it along. But we're going to focus on the markets today. And, we had another down day for the NASDAQ. This makes it four in a row, although slightly off the lowest levels of the day. Apple and the reaction to China, obviously an issue there. S&P also lower. Dow managed to buck the trend up a little bit. But what's your view of this pullback we seem to be experiencing in tech stocks?
Well, I've been of the view, and this is not something recent for some time now, that technology companies will start underperforming other parts of the market. We've had such a long period of outperformance from that sector specifically, and you can see that from so many fronts, even from capex trends of technology itself relative to resource companies and other parts or segments of the market. And it's very clear that we've seen, I think, part of this crowdedness towards 60/40 portfolios is in response also has helped a lot of technology businesses that are part of this growth story and so forth. And we've seen sort of a mirror, market behavior of the 2022 times when technology was actually leading to the downside, and now we've had such a strong performance, essentially the entire performance, as everybody likes to say, of the S&P 500 coming from those mega cap stocks. And in my view, those are just ultra long duration assets. And as you tend to see this upward movement in discount rates and interest rates and cost of capital itself, it is just hard to believe that we're not going to be discounting the present value of those companies much lower. And so I remain very concerned. I think there is no reason to be owning something that is trading at 60, 70, or over 100 times free cash flow. And when you look at the actual growth aspect of those companies, as they are called growth stocks, there is not much growth going on. It's been actually quite dismal in terms of even Apple and Meta and others. You've seen throughout the history of those businesses, their top line and bottom line has actually been not growing as anywhere close to where it used to be back in the days. To justify those really hefty multiples. So we remain very concerned about that, and I think there's a much better other opportunities in the markets right now.
Yeah, we're going to talk about that in a little bit. So one of the things you mentioned is that um, the higher interest rate environment. Fed speakers seem to be indicating that they're in wait and see mode now. Data dependent. They've kind of been messaging that, and we've seen some mixed information in the economic data. What are you expecting in terms of policy and rates? Are we maybe in for one more, or is it just gonna be that we hang at these levels? How do you see that playing out?
I think we see a little bit more, but not much more in terms of rate hikes. And then we're probably going to stay where we are for a while. And that is given what's happening with inflation. I mean, inflation has decelerated since the beginning of the year, but then now we're starting to see signs of reemergence of inflation. And that is, if you study back in history, the 40s or the 70s, both inflationary periods that actually played out very similar but different in some aspects. Different in terms of interest rates, very similar in terms of how inflation developed through waves. You
Mhm.
have the first and second and third wave in the 40s, the first and
I think
second,
we have
third
a
wave.
graph I think we have a graphic of this that we pulled from your research. Go ahead.
Perfect. Yeah. And I think we're in the process of seeing something along those lines. That is just the base effects playing, a key role into that. But there's also real supply constraints that I've been of the view of for a while too, regarding commodities. And I think
Mm.
that's going to be a big driver of inflation over time. Deglobalization to me is still, under way. I mean, it's progressing. It's still happening across different parts with a lot of geopolitical issues rising. But then, there's other things going on as well. I mean, think about the housing market, which I think a lot of people have really understood that there's a process of reshoring happening in most developed economies, but there's something else also happening, which is causing this sort of construction demand. It's not just infrastructure, and it's not just non-residential. It's actually going to be also residential because everything is unaffordable, right? I mean, if you look at the housing market, prices are extremely unaffordable. At some point, we're going to have to see, and we're starting to see, construction boom in housing market in order to adjust for those issues. And so all that comes full circle into commodities and the demand for materials. And
Mm.
so I've been of the view that this is an inflationary era. We should be treating that in that manner, and that will have implications of how the compression of multiples depending on equity markets, I think, is highly likely. And how what my biggest point is how 60/40 portfolios ultimately will look a lot more balanced in the future. And that means that we're probably going to be favoring more hard assets and things of that nature.
Yeah. So, when you mentioned we're in this sort of inflationary period, what about the growth side of that? So, is it inflationary with high growth? Because there are some who say, you know what? Whether you call it a soft landing, a no landing, but the economy looks pretty resilient. We've got a lot of fiscal spending. This is going to, buoy growth. The price you pay will be inflation, but you are going to see a period of higher growth that's sort of setting the US apart. And then there are others who just think it's a lag issue. And they are concerned that not only are we going to see a recession, but it could be something quite severe. What are your thoughts about the growth side of the equation?
Well, let's start with 2022. I think we saw the more of a severe contraction in terms of economic growth, along with inflation was still on the upside. And then that kind of peaked in the middle part of the year. We've had a deceleration since then on the inflation front. And I would say that growth hasn't, I mean, it's not that it's been reemerging from the 2022 times. It's been very resilient, as you mentioned.
Mm.
I think that there's very high risk for a major deceleration of growth into this next couple quarters here. And if that's the case, while a lot of people think that that's going to have an immediate effect on inflation, I actually think inflation could be the actual thing that could be driving lower growth over time. In other words, I'm very much in the camp of a stagflationary environment. And we're going to go in and out of that sort of scenario. But I think right now specifically, we're probably getting into one of those again, where growth is, a lot of people have been went through from being overly pessimistic to now becoming more optimistic, talking about soft lending or no lending at all. And the probability in terms of how we approach markets in order to see the probability of recession and contraction in the economy has basically gone away. It's very rare to find real bears in the markets out there right now. And you can see that on credit spreads. You can see that on valuation of companies and other things. And so those are parts of the market I think are very fragile still. And at the same time, looks to me like you've got oil moving higher. You've got agricultural commodities starting to move higher as well. And that's because the underlying issue behind those, the supply of those commodities have not been resolved. And so, we'll likely continue to see those becoming upper pressure in general for inflation. And let's not forget one more thing. I mean, fiscal stimulus. It's actually kind of shocking to see that the economy is not growing even more, given the fact that we're seeing fiscal spending, excluding interest payments, keep that in mind, close to 25% of GDP today. And obviously, that's excluding also tax collection, which we're just looking at how much the government is spending in the economy. How in the world are we not seeing an even stronger economy, right? That's more than we've seen even coming out of the global financial crisis in terms of government stimulus. So it is very significant. And throughout history, we've only seen this during the COVID recession or during the World War II. So I think, or World War I as well. So it is, it's kind of shocking that we're not seeing more growth. Personally, I do think that that's kind of the case.
Yeah. I mean, isn't it because in this case that we've had so many Fed rate hikes so rapidly? I think I heard someone say at one point, because we forget what the expectations were, we thought there'd be 2 or 3, and they just were relentless about it. And we have seen a lot of that kind of countering the fiscal, right?
Yeah. Well, it's almost like what I call a fiscal monetary dissonance, where there's a total divergence in policies, where monetary policy has been very restrictive when it comes to what we're seeing of QT itself. It's something we haven't seen to this magnitude that we're seeing today. Interest rate hikes, as you mentioned, the steepest period of rate hikes that we've had probably in many decades. And compare that with the stimulus that we're seeing from the government side. It's they're just not in line. Something's got to give, and so which one is feels like they're going. It's very impractical kind of policies, in my opinion. But I'm not the one running the show. I'm here to sort of look at the markets. I think there's going to be a lot of impact on this tightening of monetary conditions. It's just when you think about what's happening in terms of that is specifically in terms of the tightening of financial conditions, along with yield curve inversions and other things that are also tend to precede recessions. It's just I think there's the signs on the wall, and it's sort of interesting that a lot of people have gone away from really thinking that there's a high probability of a recession had. I think that the probability of recession has only increased and not decreased. The fact that it hasn't happened yet doesn't make it that the probability should be lower. I think it's the other way around.
Yeah. Um, it sounds like you think the market is mispriced. Is it bonds and stocks all around? You think that there's too much complacency?
I think equities are more mispriced than bonds, but bonds are also mispriced. When you think about what's happening in terms of the issuances of treasuries, something I've been covering very
Mhm.
closely. This is insane. I mean, what we've had even from the debt ceiling problem. I think this is a debacle that I'm not sure how we're going to resolve this, knowing that there's not enough buyers of treasuries out there, and instead, we're seeing the Fed actually being a large, depleting its assets in a very significant way. So, to me, this is, it comes again full circle onto why I believe gold is going to play a big role into being a defensive asset here. But on top of it all, you have something called the twin deficit issue, which to me it's a structural problem in the U.S. I mean, if you look at the chart of twin deficits,
Yeah, we
which
have
is
that. We're gonna try to pull that up if we can.
perfect. And if you look at the chart specifically, which is just looking at the fiscal deficit and adding along with the current account, which is essentially the trade balances most of that number, and you put it together, we're at double digits right now relative to GDP. And clearly, it is gradually getting worse every time we have a recession, which makes you or suggests that potentially we could see even lower twin deficits. What does that mean? It just means that we're going to be compounding the debt problem even faster. And so, how do we do that in terms of if the government is not collecting really a lot of revenues? Well, that means somebody's going to have to be buying those treasuries. Banks are not doing that. The Fed is not doing that, and foreign institutions are not doing that. So, yeah, I think the bonds in general are also mispriced, but equities are even worse because they're priced as not only for perfection, but like we're going to see another disinflationary period with high growth and as I said, falling inflation. So just I think it's going to be quite the opposite in the next 5 to 10 years.
Yeah, so do you think a lot of people, and we could do a whole show on this, so I don't wanna go too far down the rabbit hole, but we talk about one of the things I think that factors into the equity call or the people who wanna stick with it is there are still rate cuts being priced in for next year, and if that's the case, you either believe there's going to be a recession or you think the Fed's going to be forced to have to cut rates because they simply won't be able to make the government won't be able to make the interest payments on this huge amount of debt that's out there. Um, is that a case for equities or is that faulty thinking?
It's like what comes first, the egg or the chicken. But to me, it's sort of, first you need to see the pain. And first we need to see a severe recession to see the Fed really doing what the euro dollar curve and other interest rate instruments are really reflecting in terms of the expectation for rate cuts. We do need to see that pain being reflected in markets. I highly doubt we're going to see the Fed really cutting interest rates when inflation hasn't really gone even below their target. We're still above it, well above it in core in core inflation indices. And so, in my opinion, that is a bigger part of the issue. And specifically, if rates just stay where they are, remember, it's not, how do we price something? It's not necessarily using risk-free rates. You have to be applying that to the cost of capital of that business. And junk bonds is a great gauge of that. Junk bonds being at about 8% today, which is actually quite low relative to where risk-free rates are. In other
Mm,
words, credit spreads are very tight because risk-free rates have been rising and junk bond rates have not been rising even further, because we haven't really seen that kind of contraction in the economic numbers that really cause credit spreads to blow out. So, but even at 8% junk bond yields, I mean, this is quite significant. And how do we justify a lot of those companies? There are companies now that are going to be rolling their debt in 3 years from now, which is likely to be completely squeezing their margins moving
mm.
forward. Another thing I'll just suggest, I mean, just look at the manufacturing indices. Just those surveys that come out where you have executives sharing some of their opinions about their businesses. It is brutal what we've had recently with the
Mhm.
Kansas City and the Dallas one, in terms of the commentaries, in terms of interest rates killing their businesses. And I'm actually paraphrasing that. This is sort of most of the phrases is regarding how financial conditions are starting to hurt those companies, and the wage price spiral with that pressure from the cost of living causing folks to demand higher remuneration is also having an impact on their margins. And so, I don't think that's really is still reflected in equity markets, and I think it's still to be the case here in the following quarter or so.
Yeah, great points, and something that was brought up as well yesterday with Paul Hodges talking about the chemical sector and the terrible capacity rates they have and the pressure on margins there. And it's always worth digging into deep into those reports, as you just mentioned, to hear what people who are actually running businesses in the real economy are saying. It's so important. So, Tavi, we've already got some questions coming. So, hard assets. So, in this environment, you think that's the place to be. What do you like here?
Oh, I think you want to diversify across those assets. I think there are plenty that you can look into. I happen to be a big believer of commodities because of that, and I think there's many ways to express that opinion in the markets. Number one, I think when you think about defensive assets within this sort of hard assets part of the market, I would say gold comes first and foremost as the key alternative. I think gold will outperform treasuries in total return basis as well, just like we saw in the 70s when gold was rising despite the fact that interest rates were rising. And that is going to be driven by, first and foremost, the accumulation of that metal through central banks, which is already happening. And I think it's only going to increase over time as we see more FX volatility. I like metals and mining in general. I like silver a lot. I think, if you're a
Let's put a
believer that,
chart. We'll go back to gold because there's some questions. Let's put a chart of silver up as you talk about this, if
yeah,
we can.
well, silver has a lot of reasons to believe that silver will play an important role here if gold is at the beginning of a cycle. I think, to believe in that, you really got to dive into why precious metals in general should be entering a secular movement to the upside. And by the way, when you see one of those, we've never seen in history a gold cycle that wasn't accompanied by a commodity cycle. And so, that is why I think everything is interconnected. But nonetheless, gold, just looking at the production for gold, it's been declining across most of the major companies. The interest from capital allocators has been as bad as it could be. We were seeing central banks accumulating the asset over time. 60/40 portfolios have never been more expensive. I'm going to be coming out with a report here soon, really diving into the valuation of 60/40s, because I think that's key. In fact, if you look at gold itself, downside volatility right now relative to the downside volatility of treasuries, it's a lot more attractive to own gold in your portfolio for the first time in many decades. So, or actually in the history of the data, to be quite honest. And so, I think there's many reasons to believe that the market is getting very favorable for precious metals in general, and silver should lead the way to the upside. Because if we just look at the ratio for gold to silver right now at 80, it seems quite attractive to me as well.
Yeah. Well, I think I like to blame everything on the heat. We're freezing a little bit, but we're going to keep going because the audio is working, and so we'll bounce back. So bear with us. If you're frozen, so am
I
I.
actually
Maybe
think
you're
my
not.
my computer just froze. There you go. I'm back.
Yeah, we're
Is
we're
that
I
back?
think we're all freezing. Well, we're all melting, so we're freezing. Where if you're sitting anywhere on the East Coast, much of the US, which of course we have a global audience, but I don't know where it is where you're sitting, but it's very, very hot here, and we always start to get the gremlins to come out when that's the case. But I think what you're saying is really important, and we just had the gold chart up as well. So let me get a question in here. Trillion X asking Tavi, what do you make of the oil to gold ratio still being above its 40-year average?
Well, I think that it is an interesting measurement. I used to look at those, especially for sort of gauging economic activity in general. So when you see gold to oil ratio rising, it tends to be showing weakness in the overall economy. The other way around would be the opposite of that. And but I'm not sure that's really the play. I actually think both could be rising here. So I'm not really looking to be hedging that position by being short oil or by being long oil and short gold. I think in my view, you want to own a basket of those things, and you also own a basket of businesses that have those underlying commodities as part of what they produce. And there are many ways of doing that. I like energy companies quite a lot. I think they're very cheap, historically undervalued. But not only that, geopolitically, energy commodities are playing more and more of a bigger role here. And you can see that strategic petroleum reserves declining in a significant way. If you look at oil rigs in the US, they've been contracting for the first time since the COVID recession. If you look at capex in aggregate for most energy companies, they're still historically low. And so all those things are fundamental reasons why you want to own energy here. I don't want to bet against that. So, I like to own oil. I think oil companies are a big part of my portfolio. I think that's an important aspect of this inflationary regime that tends to really benefit oil businesses in general. And so, actually, I'm quite bullish on oil and gold as well.
Great question from Doug. Of the three asset classes, which do you rate as the best value? I'm just going to preface by saying we're asking Tavi. He can't say what's best for you. We don't give financial advice. Only you can know your own risk, what the rest of your portfolio looks like. You know the drill. But Tavi, in your mind, for you, which of the three asset classes do you rate as the best value? PGMs, gold, or silver?
Um, hmm. Well, I think depends. Well, if you're looking for an explosive move with high volatility, silver is by far the best option here. Now, if you're running, let's just say, a large pool of capital of a lot of of with a lot of liabilities and things of the manner, which a lot of ways people think about yield as a source of income for those portfolios. I actually think gold's going to play a big role into those because of the sell-off in fixed income markets. And so, it really depends in terms of that. What I think it's very attractive is the fact that when you looked at, how much worse can gold prices really get from here? How much is the downside that I can see from gold prices from the current levels? And if the downside is small, I want to take risk to the upside. So that's why I think there's a lot of asymmetry to finding other businesses that have lower liquidity, lower volume, that potentially could provide that level of upside if we're right about gold prices really entering a gold cycle where it could take 5 to 10 years for those to materialize. And so to me, that's where I get more excited. It's not really buying gold or buying silver, is looking for very unique ways to deliver performance by finding companies that you can either turn them around in terms of mining businesses. Even in the private market. I mean, the private market for mining is incredibly attractive right now. So I think there's a lot of ways to create value in those industries, and the fact that there's so many inefficiencies and lack of people and capital really focusing in that part of the market is to me quite attractive. So that's where I spend most of my time personally, and through the Crescat as well.
Yeah, I love that explanation because you explain some of the fundamental story that you're looking at, but also your time frame and what kind of move you're looking for, right? So if you want to have and you're willing to have the stomach for volatility, all those things are so important for all of you who walk through the academy. We try to break that all down. You heard Darius talking, I think, last week or earlier this week about creating a framework for yourself, knowing what kind of profile you want to have. All of that really just fits into how Tavi was talking about his approach to metals. Another question on that from Raymond, another great one. Um, is your focus more on specific precious metal business or the price of the actual product? I think you sort of touched on that, but how do you think about that? It's a great question, Raymond.
Well, I think that looking at the supply and the demand side of precious metals, I believe strongly we're going to enter a very long-term bull market for precious metals overall. Starting from there, I like to have optionality when I invest on something, and when I find myself looking at most exploration companies where they have properties with very high probability of discoveries in terms of looking for further resource in those regions. And I look at the valuation of those companies relative to others that don't have, or have very small probability of finding something. There's not much of a gap between the two. In other words, everything is priced for failure right now in that part of the industry. And so, if you're taking a long-term approach, just kind of a hybrid venture capital way of investing in the space. What is venture capital approach? The venture capital approach really is investing in a lot of startups, and maybe one of them turns out to be a unicorn or something along those lines that pays off your bets on the other ones. That's sort of the type of strategy that I get excited about in the mining space, and I've been doing that for the last years. And so I think that the whole space. I mean, if you just think about the number of geologists right now, the number of people really focusing on learning about that part of the industry itself, it's at all-time lows. There's been a long-term decline in interest
Mm.
for folks to become geologists, and so of course that's going to reflect in the price of those assets. And it's very clear if you dive in, you're going to see there's not enough folks that really understand the industry very well, technically speaking. And so for those that have sort of a value shareholder approach to really drive some sort of way of driving value over time, I think that those are, there's significant room for that. And remember, the way most of the people, the billionaires of the mining industry made their capital was with making new discoveries. And you
Mhm.
can look at the list of them. So why not, focus most of the capital that has been so scarce in that part of the industry, specifically into that part that has such a strong potential for large growth in terms of returns. And so by no means I'm saying this is easy. It's very difficult. It's very technical. However, I think there's room for folks that want to really dive into that space. The same way there was room for crypto and other
Mhm.
industries or oil in the last 2 years or so. I think that the metals and mining industry will become more and more, opportunistic as we see not only the price of those instruments moving higher in terms of the underlying commodity price, but also given the fact that there's in my opinion, a cap downside in terms of prices, given the fact that supply is so constrained.
Fantastic stuff. Tavi, always great to catch up with you. We're out of time, but very quickly, Trillion X asking, assuming you're still bullish on Brazil.
Oh, I'm very bullish on Brazil, and this is, I think people get a little confused about uh, tweets and investment ideas. Tweets get around because things have happened recently, and that's not how investors should behave. Investors should be putting their money when people are not really interested in that topic. And so tweeting something to get around is very different than making the right decisions most times with your portfolio. And recently we've had Brazilian equities declining significantly. And I'm not saying they've got historically, we didn't see major shocks in Brazilian equity markets, but we did see a large correction. And if you are a believer of those markets over time, that is the time to be stepping in. And so, in my opinion, I think the banks look really cheap. I think commodity producers in Brazil look really cheap. And the overall market in Brazil looks cheap. Real estate in Brazil looks cheap. And I much rather pay 3-5 times earnings on a company that has potential growth, major growth, relative to FANG stocks trading at over 60 times earnings with declining growth for the last decade. And so to me, it's sort of a no-brainer kind of strategy.
Yeah. Great stuff. And great point about the tweets, which is why we try to take the time here at Real Vision and speak to people at length and get their views on it and have people on with divergent views so we can all sort of educate ourselves and see what best fits for us. And we're going to do that starting next week with a super great campaign that we'll tell you more about tomorrow. Tavi, we love catching up with you. Thank you so much. Congratulations again on your first child. It's a wonderful, everyone in the chat is saying congratulations as well. Buckle your seatbelt. It's going to turn your life upside down, but in the best way possible. So we're thrilled for you.
How do I hedge?
How do you hedge? Exactly. I'm sure we're going to get some thoughts on that in the comments. Tavi, thank you so much. Thanks to all of you for the fantastic discussion. We'll see you again. Remember, same time tomorrow. We're back at 4 p.m. on Friday. So please join us then. In the meantime, take care and good luck out there.